Well, good afternoon. Coming to you live from the Johannesburg Stock Exchange to check in on those markets. And we're looking at Asian markets that were particularly higher, even though we have a reminder from Fed officials that interest rates will need to still go up in order to quell elevated levels of inflation as we look at Chinese markets also in positive territory. And this is on the back of the PMI figures that came in over the weekend, showing a slight growth. Hang Seng fractionally higher, looking at the Nikkei in Japan closing in positive territory, up 0.6%. European markets at this point having a bit of a cautious start to the trading month of August. Of course, when we look at what's going on locally, in particular the rand, that's been bolstered right now by a weaker dollar, with investors taking bets that Fed officials will have to slow down the pace of interest rate hikes as it stands. The rand 16.47, US futures also slightly lower, even though we had a fairly good month of July, probably the best month coming off since 2020. But to talk to us about the latest market dynamics, we are joined by Viv Govender, who's a senior analyst at Rand Swiss. Viv, thank you so much for your time. And just looking at those US futures right now, slightly lower compared to, the month that we saw in July. But let's look at the overall, JC performance right now. How are we kicking off August?
Yes, we are seeing basically a big recovery coming through from the lows we saw a little while ago in global markets. But, as you mentioned, we are still expecting more rate hikes to go forward in the future. Right now, we are seeing, the market kind of forerunning the expected rate cuts before the rate hikes are even over. So that's pretty, I think, making a pretty strong assumption about just when the Fed is going to stop hiking rates and when the rest of the world can stop hiking rates as well. We haven't seen inflation peak yet. We've seen basically GDP come in worse than expected for the last number from the US Fed. But like I said, the US markets are really, really optimistic about just what we're going to be seeing coming forward with regards to rate cuts. And our local market at the moment is positive right now, but we're just following global trends right at the moment.
So you look at Liberty 2 Degrees that released their financials on SENS this morning. What's your conviction in general when it comes to REITs?
Well, I'm personally not very positive on them at the moment for a number of reasons. Firstly, we still haven't seen the full after effect of the shutdowns, etc., in terms of ending the work from home trend. Yes, online retail has not basically carried on as it once did, but I think it's a kind of a substitution effect, quite frankly. I think if you do have more work from home, online retail becomes less attractive. People just want an excuse to get out of the house. So if they don't get out of the house for work, they might as well get out of the house to go do some shopping. So that's one bit of positiveness we are seeing. In terms of their numbers from Liberty, we have seen some numbers are better overall than they were in 2019, showing that not only have we recovered from the crash of 2020 with the COVID lockdowns, but we are better than we were before that. But like I said, we still haven't seen the full shakeout of the whole property sector from exactly what's going to be the after effects of work from home, lockdowns, online trading, etc. And the next thing is that as interest rates rise, REITs are pretty heavily geared. And they are going to be suffering because of that. At the same time, because of the interest rate hike, we are going to see lower economic growth, possibly a recession come through, and that's also going to be negative for property. So right now, I'm a bit nervous about the property sector. It's been really strong for quite some time, and I do think that the current market conditions are not positive for it.
Speaking of nervousness, how cautious are you then in this current environment? And I suppose then, what are you saying to your clients?
Well, I'd point out the fact that, this is by no means the strongest rally that's ever been in a bear market. I mean, we've seen rallies in excess of 15% for market, an overall downward trending market. Right now, we're about 10% or so. So we are seeing a nice recovery come through. We are seeing markets, higher than they were off their lows. But the overall market conditions are very nervous. We have, for instance, interest rates still rising. We don't know what the end of that's going to be. The market right now that just predicted a top to the hikes. They're actually predicting when it's going to start falling. We have not seen inflation fall yet. The market's predicting inflation is already going to start falling. We've already peaked on inflation, and they've been wrong on that the last, I think, 2 or 3 times. We've seen inflation reduce from the US. We have geopolitical concerns, not just in Russia, but now apparently in China as well, because of things like, for instance, Taiwan. Oil prices have come down, but we are in summer in the northern hemisphere, and as we get to winter, and we've seen Russia cut supplies to places like Latvia in terms of gas supplies. Energy is going to be a huge constraint going into the second half of the year. So there's a number of negative wins here. So I'm saying don't believe the rally at the moment.
All right, then when you look at US earnings, so far, has it lived up to your expectations?
Yeah, look, I mean, if you look at it from an overall point of view, in terms of like the overall historical levels of earnings, I think we've beaten more than half the companies have beaten, basically, and that's above the historical average. The historical average is about just under half the companies beat earnings historically. That being said, the last 5 quarters have been very positive. Over 60% of companies have beaten in the last 5 quarters, and this is not going to be up to that level. And also remember that markets have taken a bit of a downturn in terms of their expectations for earnings as well. So yes, we are beating weaker earning expectations. I mean, the example I'd give out there is Netflix losing 1 million customers. The market rallies on that news because they expected the loss of 2 million customers. So expectations have come down, and we are beating slightly above average. But like I said, the expectations coming down may be something that continues going forward. And I don't think the market's fully pricing, a long-term drop in earnings because of a longer-term recession. And right now, I think there is still a danger of that occurring.
Before I let you go, a key event you're paying attention to this week or earnings?
Well, the key event I'm paying attention to this week is what's going to happen, particularly with Nancy Pelosi's visit to China. There have been some incredibly, hawkish statements from some Chinese state media, not from the government itself, but from media that effectively is controlled by the government. Even like a comment about shooting on the plane, etc. I think that's the next, flashpoint in the global political situation, and we need to keep a close eye on what's happening between China and Taiwan, because if there is a flare up there, it would make the Ukraine-Russia situation look like an afterthought.
All right, let's leave it there, Vivian. Of course, throwing to the week, we do have the Bank of England's interest rate decision on Thursday. Not forgetting earnings coming out of Starbucks. Those are Q2 earnings, as well as earnings coming out of Alibaba. But we will be unpacking those as they unfold, and of course, as they do come through the wires. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.